Hey everyone, Rob B here with Rob D. And you know what? In most circles, if you talked about tax, you'd be worried about anybody listening. But property investors are obsessed with it or obsessed with understanding it. And rightly so, because the difference between getting it right and wrong could be the difference to you of thousands of pounds. So this episode is a must listen.
Welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. Yes, like Rob said, tax is a very popular subject among property investors, but not one that we've covered for a while. So have we changed our views? Have we learned more in the intervening years? Stay tuned to find out, because you might just learn something that saves you a lot of money. And stick around to the end, because in Hub Extra, we've got a resource for you that might leave you with no mates, but feeling very secure.
So Rob, it's always good to be green. But it's especially good to be green if you're a landlord right now. We've got two news stories that are great incentives for landlords who are looking to be even greener.
Yeah, a bit of a trend. So the lender Keystone, which is not one of the big ones, but they are a buy-to-let lender, is offering discounted mortgage rates, cheaper by 0.15%, for properties that are more than 5 years old and have an EPC rating of A to C. So it's an incentive to get the energy efficiency of your properties up. 0.15% doesn't sound like a lot, but clearly if you're borrowing a couple of £100,000, the interest on that could make a bit of a difference. Of course, this isn't a reason to go to Keystone. There's lots of factors in which mortgage you select. It may or may not be the cheapest. Their rates tend not to be the best. So the advice is always to go to a mortgage broker to find the best product for your situation. But it's just kind of interesting that they're doing this.
It is interesting, and not wanting to be left out, the Mortgage Works, which is part of the Nationwide Group, so a major lender in the sector, has a new mortgage product called the Green Further Advance. And a further advance, if you don't know, is where you have equity in your existing property already and you go to your existing lender and you ask for more. So instead of remortgaging, you get a further advance. Now, they have a further advance available at a very competitive rate of 1.49% for loans up to £15,000 if you intend to use that money to make it more energy efficient or greener, if you like. So is this a bit of a novelty? Is this just something that they're doing to be seen to be doing the right thing? I obviously can sense a little bit of skepticism in my tone, but overall, whether it is or it isn't, it's still a positive move. It's still a good thing to see. Will other lenders catch on and start delivering other products like this? Well, hopefully. It could be the start of a trend, or it could be just a minor blip and a little gimmick by a couple of lenders. We'll see, but it's one to keep an eye on at least.
Buying property in a limited company. There was a time on this podcast back in 2015, 2016, when barely a week went by when we weren't talking about this topic, and every question we were getting in was around this issue. If you're not aware of why that would be the case, well, we'll get into the background very shortly. But that was a while ago, and the tax changes that sparked all this have been fully in place for over a year now. So this seems like a good time to return to the issue, review your options, and see if the general rules of thumb that we were talking about at the time still apply. And thanks to Matt for prompting us to revisit this topic.
Now, tax for many of us can be an indulging subject, so you may want to go right back to the beginning with this, and we can help you. We've got a great video that you can watch on YouTube called Should You Buy Property Through a Limited Company? And what we discussed there absolutely still stands today and is very much worth a watch. And while you're over at the Property Hub YouTube channel, make sure you subscribe so you don't miss any videos like this. But in that simple video, we look at the core concepts. Now, not a lot has changed, but what has happened is we've had time. We've had time to look at both strategies play out. Both strategies being buying through a limited company or buying in your own name. And it may not seem like a long time, but actually these rules were introduced back in 2015. I can't believe it was 2015. But there we go. Time passes quickly. And because of that, we've now all got experience of buying through limited companies or in our own names and assessing, have I done the right thing? Because undoubtedly there are people now operating in the wrong structure.
So you could watch the video for the full background, but to give you a really quick summary in case you're not up to speed with this, these new rules that were introduced all the way back in 2015 meant that individuals could no longer claim mortgage interest as an expense, whereas companies still could. So all of a sudden, overnight, owning property in a company appeared a lot more attractive. What this meant for individuals was that they were left basically paying tax on profit that isn't really profit. because it ignores the cost of interest. And just to make life a little bit more confusing, that only really affects people who are paying the higher rate of tax, because at the basic rate, you get a deduction that cancels the whole thing back out. I know the simplified version is turning out to be not that simple, so do go watch the video if you're not up to speed with all this. But the upshot of all this is that I'd say the majority of investors that we come across now use companies, whereas previously it was really rare. It just wasn't really a consideration. Everyone just bought in their own name by default without thinking about it too much. So these rules have been gradually phased in over a few years until they fully came into place in April 2020. So now we are 1 year on from these rules being in effect.
So why are so many property investors using a limited company to invest with? Well, the main benefit is you can still deduct mortgage interest. But that's not it. The tax rate is lower. Corporation tax is currently 19%. And despite the recent changes by the government, for most property investors, it will remain at 19%. Whereas if you're taxed on your income, it could be 40 or 45% if you're a higher rate payer. It's worth saying on the tax point, though, is that you're going to be charged on corporation tax if you let the income build up, so you're not taking money out of the company. But if you decide to take money out of the company, then you're charged the 19%, and then you're charged income tax on top as well. So limited companies are really for investors who are in this for the long term, aren't trying to live off the income today, and see this as a retirement/legacy play. So you build up your funds in your limited company, you might reinvest it, and then when you decide to stop working, you stop your income there and you turn on your income tap through your property investment company. But what you don't want to be doing is setting up a limited company and deciding to pay yourself from it on top of your own job, because you're going to be paying income tax on both, but also corporation tax on the company. Now, if this is new to you and your head's starting to hurt a little, go back and watch that video we referenced earlier. It's worth also saying with limited companies that for the long-term options for passing property on, there are tax-efficient plays you can make there as well. For anything like that, and actually for the majority of what we're discussing today, please do take good tax advice. We're not saying that investing in a limited company means that you are sorted for passing property on in the long term, far from it, but it's a useful structure to start with if that's your intent. And speaking to an accountant who understands this, they'll help you to plan properly. So there's lots of positives, Rob, if you're in this for the long term and you're not looking to take an income out in the short term. But there's more to it than that.
Yeah, it's not cut and dried. As a result of these changes and so many investors deciding to make the switch, it's almost become accepted that, using a limited company is the thing to do now. That is what you must do. But that's just not the case, because there are downsides as well. The big one, you've already talked about, Rob. If you actually want your property income to live on, then you end up paying more tax than you would have done otherwise, because you've got your corporation tax and then you pay tax on your dividends. So that makes it a lot less attractive. But there are some other drawbacks as well. One is higher accountancy costs. So if you've got property in a limited company, you're almost certainly going to need an accountant to submit your limited company accounts. There's a minimum fee for them to do that, even if you've got very little going on in that company, just because there's lots of compliance work around it. So if you've only got one property, the accountancy costs could end up eating up the majority of your profit. You've also got higher mortgage costs in a company because mortgages for limited companies are more expensive. And we're going to come back to that point very shortly. And the final major drawback is that limited companies don't have a capital gains tax allowance. So if you're selling a property as an individual, you've got an annual capital gains tax allowance of about £12,000. So the first £12,000-ish of any gain, you don't have to pay any tax on. A limited company will pay tax on any gain from the very first pound of it. So when it comes to selling properties, you'll pay less tax if you are an individual compared to a company. So taking into account the pros and the cons, Rob, you end up coming to a rule of thumb that we've been talking about for a few years now.
Yes, absolutely. And it still stands today. The general rule of thumb is that if you're building a portfolio for retirement or legacy, a limited company might be best for you. But if you want to invest in property for income now, it might not be, because as we discussed, you'll be taxed twice. Once for corporation tax, and then when you take the income out, you'll be charged income tax. But even if you're doing this for the long term, there may be other reasons why you may not invest through a limited company. At least there are things that you need to consider. And because now we've all been running portfolios of limited companies or not, we're able to look back and assess what's the best way forward. And mortgage rates are a really important factor here, probably more important than they first appear. So let's take a look at mortgage rates for both buying as an individual and buying through a limited company.
Yes, let's take a look at one major lender's rates for individuals and companies. We'll look at the Mortgage Works. They're a very popular lender for investors. So they've got a 2-year fix for individuals that you can get from 1.64%. Pretty good. But if you wanted to do that 2-year fix as a company, they would charge you 3.29%. So that increase in rate more than neutralises the mortgage interest aspect, because for companies, it's more than 40% higher. So if you strip out all other factors and you're just looking at the ability to write off mortgage interest balanced out against the cheaper mortgage rates, you end up coming out ahead as an individual because you're giving more to the government but less to your lender. However, you do still have to bear in mind that having mortgaged properties as an individual does push your personal income up because your income figure is calculated before you take off the mortgage interest. So you could end up getting pushed into a higher tax band before you otherwise would do. So already we're starting to see that this decision between personal versus company is not cut and dried. So it's worth looking at a few considerations that might affect which route you want to go down.
So first of all, let's look at how much income do you have? So if you earn up to 50k or 100k as a couple, you'll only pay the basic rate of tax and can deduct mortgage interest in full. If you're unlikely to go above this, you can buy in your own name and then benefit from the cheaper rates. But remember, you have to make sure that the income that you then receive doesn't take you over that tax band threshold. So make sure that you've got plenty of bandwidth there and that extra rental income isn't then going to change your tax category, because then obviously it's less attractive.
The next consideration is how you get paid. So if you are an employee, then you don't have a lot of flexibility, and this doesn't particularly apply. But if you're a contractor, for example, so you get paid into a limited company, then you've got the option of buying properties personally instead. Remember, like Rob said earlier, what you're trying to avoid is having two income streams on at the same time, and therefore pushing you into a bracket where you're paying a lot of tax. But if you're a contractor, then you've got the option of buying properties personally, living off the property income, and then leaving your earned income within the limited company. So you've still only got one stream on at a time. That means that just like before, if you're earning up to 50,000 or 100,000 for a couple, you only pay basic rate tax and you can deduct mortgage interest in full. You get to benefit from the cheaper mortgages for individuals, and you get to benefit from the fact that you've got a CGT allowance if you decide to sell one of those properties. And in the meantime, you've got money building up in your company, which can make pension contributions for you to reduce the corporation tax bill or invest in other assets or do whatever it wants to do. In fact, what many contractors do is the opposite of this. They actually buy properties within the same limited company or another company that they own. But you don't have to do it that way round. Doing it this way round does allow you to have some of the benefits of buying individually without having those two income streams going on at once. So if you do have that kind of setup, so you're not earning solely as an employee, you do have a lot more options.
Your next consideration is, where is your money coming from for this? So you've got funds to invest with, but how have you got those funds? Now, if you're a business owner and your investment funds have been built up in a business, then you take a big tax hit taking it out that business. You would have paid corporation tax against it, and now you're going to take a income tax hit. So if you are a business owner and your funds are coming from a business, you may be better off investing through that business or a dedicated property business that you set up, limited company, and you lend money from your business to that business across. There's no tax for that if you loan it. Of course, you have to pay it out and you have to set it up in a proper structure and again, get proper advice around that. But it's pretty straightforward if you do it right. So therefore, if you are a business owner and your funds are tied up within your business, then a limited company might be best. Now, if your funds are coming from remortgaging your home, then there's no tax to pay on that. So you may want to invest in your own name. Of course, any inheritance you receive as well, you could invest in your own name. Before you make a decision, you have to take all these considerations into account. How much income do you have? How much do you get paid? And where is your money coming from? And once you've assessed all those considerations, you can start to decide what to do.
And you can end up with a mix and match approach, which is what many people ended up doing by accident because they'd already started investing as an individual prior to 2015 and then changed their mind afterwards. But if the circumstances are right, you can still take that approach now. So you could start buying personally to take advantage of the fact that mortgages are cheaper, you've got the CGT allowance and all the rest of it. Then, when you max out your basic rate band and the tax is going to start getting a bit painful, you can then switch to buying in a company. That way you get the benefit of investing personally, including the benefit of actually being able to have that income to spend if you want to. And then you can switch from that into a company before the negative consequences really start to bite. If you do that, then those properties that you own personally, you can move across to a company later if your circumstances change. But be warned, this is one to file under not straightforward. Even though you might take the view that, well, it's either just me on my own or it's me as the maybe sole director of a company, same thing, I can just move it. No, they're separate legal entities, so you actually need to sell the property from one to the other, which has all kinds of tax consequences. There are things you can do to mitigate that, but there's still no perfect solution, and they're all a little bit complex. So if that is the situation you're in, make sure you take tax advice. And bear in mind in general that moving from one to the other is not a trivial matter. So while you can't perfectly predict the future, you need to do as good a job as you can, because while you can change your strategy, and that's fine, moving individual properties from one to the other is a bit of a pain.
And just before you make your decision on what you do, it's worth also considering what the future could bring. Because interest rates for limited company mortgages when they first came out were higher than we discussed today. And it's reasonable to expect that they will come down further in time and get closer to personal mortgage rates, which then would make redundant some of the benefits we've discussed in this episode. It's also worth bearing in mind that if you invest in your own name, then you can attract higher rates if you have 4 or more properties, certainly from some lenders anyway. And again, when you get above 10 properties in your portfolio, your lending options are restricted, and because there's less products for you to choose from, the rate you pay may be a little bit higher. So it becomes less attractive the bigger your portfolio grows. And of course, the bigger your portfolio grows, the more income you would receive, and therefore standing more chance that you'd be taken through that tax threshold. If you're on the lower rate currently, you could very well end up paying the higher rate because of that. So there is a lot to consider here. And you may want to go back and listen to this episode again and watch that YouTube video like we've discussed. But Rob, in summary, the rule of thumb that we talked about earlier still does apply, just with taking all these things we've discussed into account.
Yeah, I think the experience of a few years has borne out that rule of thumb that we started with all those years ago. But I think there's a danger that it could just become almost dogma that you must do it one way or the other. Because all the talk over recent years has been around limited companies. It's very easy to get the impression that that is just the thing you should do. That is the right answer for everyone. And there are people out there happily giving the impression that is the right thing to do for everyone. But nothing is ever that cut and dried, especially not when it comes to tax. And there are many different circumstances, some of which we've talked about today, that mean that it's not going to be the right option for some people. So unfortunately, there's no way around it. You need to take a bit of time to understand tax. It would be really nice if there was just an easy answer that you could have, and then you could just know you've done the right thing and not have to worry about it. But because there are so many considerations and everyone's circumstances are slightly different, you need to really think this through. An accountant can, of course, help you to think this through, but they can only do that if you have a good understanding of what your goals are and what your future circumstances are likely to be. If you're not able to say whether you're planning to acquire 2 properties or 10 properties, or whether it's important to you to have that income to live off or not, or whether you're planning to pass these properties on or sell them, they're not going to be able to give you good advice.
But it's worth putting the time in to understand this yourself, so you can sense check the advice you've been given and make sure that everything you do from this point on is done correctly. As we've said, you don't have to stick to the strategy you're currently implementing. You can mix and match. So if you find that you've got some in your own name currently, but you'd be better off investing through a limited company from now on, then you can do that. And vice versa. There is no rule that says once you make a decision, you have to stick to it. So if you're already investing, review your position based on the things we've discussed today. And if you're new to property investment, well, look at you. You can make the best decision based on all the experience we share today to make sure the way you invest is right from day one. But like Rob said, take our information and then have an informed conversation with an accountant, because not all accountants are created equal. You'll end up knowing more from watching a YouTube video and listening to this podcast than a lot of accountants, unfortunately. And it's not that they're bad accountants, they're just not property experts. So just be wary of that. But having all this information at your disposal will mean you'll be much better placed to assess them. But whatever you decide to do, good luck, and make sure you do it, because the difference in tax that you could be paying one way or another could be significant.
Well, whatever you do, you're going to end up paying some tax. And maybe a way to make yourself feel happier about that is to go, hey, it's just a byproduct of success. And success is something that we love to hear about on the podcast. We encourage you to send in your success story, whatever it is that you achieved that you're feeling a bit chuffed with yourself about. We're on all the socials at Property Hub UK, or you can leave us a podcast review wherever you listen, which we always appreciate as well. This week's success story comes in from Chris. He's actually emailed us to say, my first week as a Property Hub member has been unbelievably helpful, and I've already watched the 18-year property cycle course, as well as listening to 20 to 30 podcasts from the back catalogue. We're based in Singapore and have been flirting with the idea of buying a buy-to-let property in England, and the podcast has provided us with a basic understanding of guidance we needed to press ahead. We had an offer accepted last week and are now going through the process of a mortgage application and conveyancing. I've also been thinking a lot about our long-term goals. Keep up the great work, and thanks so much for the open access to all your knowledge and expertise. Well, Chris, that is quick work. As if watching a course and listening to 30 podcasts wasn't enough for a week, which I think it is. You've actually managed to get a very long way to getting that first property under your belt. So well done to you. Keep up the pace.
It's time for Hub Extra now, the part of the show where we want to give you more. We don't want to go out on a whimper. We want to keep things strong to the end of the podcast. And this is all backed up by the weekly Hub Extra email that goes out to all Property Hub members every single Friday. And remember, becoming a Property Hub member is completely free. You just sign up on the website. You'll be able to have access to all the courses for the cost of £0 and get this lovely email as well. It's probably the best property deal you will ever do. This week, we're giving you a couple of resources, actually. Many of you listening, probably the vast majority of you listening, will use WhatsApp to communicate. I'm not going to explain what WhatsApp is. I'm sure you know. But many of you will also know that they are constantly changing their terms and conditions around their usage of WhatsApp. And people are starting to become uncomfortable with the insights that WhatsApp have into what you're doing and what you're using. And Elon Musk quite publicly recently said he's leaving WhatsApp because he's unhappy with the privacy or lack of privacy offered by WhatsApp. So our resource or resources today are a couple of different options, and they are Signal and Telegram. And both are apps just like WhatsApp that everybody can access for free, but the protection around your privacy of both of those apps is far superior. So you may be thinking, well, Rob, I'm not a criminal mastermind, so I don't care too much about my privacy. And that's fine. Most people will be comfortable using WhatsApp. But when you are targeted around the internet with things you're discussing in WhatsApp and you think, you know what, it would be nice just to use the internet without being bombarded by advertisers, then this won't eliminate that, but it's just one step in the right direction.
Yeah, the drawback to this, of course, is that everyone you know is using WhatsApp. So there's not much point you switching to Signal or Telegram if you're there on your own with no one to communicate with. And that's the problem with all of this. It's all about network effect. So Signal and Telegram are better products than WhatsApp. They do exactly the same thing. They've got the same features. There's nothing you can't do that you can do in WhatsApp. But WhatsApp is where everyone is. But maybe the privacy element doesn't bother you, but I feel like it should bother people more, because if everyone was using a more secure system, then people who do have a legitimate need for privacy for their own safety would be able to have it. But having said that, I have just got my mum onto WhatsApp and I'm not about to try and move her again. So I'm not making the switch just yet. But if you're listening and you do object to what WhatsApp is doing, you want more privacy, and you've got the tenacity to get a good number of the people you know to move across as well, then do it.
Well, that's us done for another week. I hope that episode wasn't too taxing for you. Oh, sorry, had to leave on a pun. But we'll be back on Tuesday, possibly with more puns, for Ask Rob and Rob. And we'll, of course, be back for the Property Podcast on Thursday. And if you want to check out our new podcast, please do. It's called Any Other Business. It's got its own podcast feed, and it's us discussing our business, life, world, and our big plans for the future. So if you're interested to know what we're up to, go and check that podcast out too. So plenty of content to keep you busy. We'll leave you to it. Take care. Have fun. Bye-bye.
Bye-bye.